Welcome, and thank you for joining me today to investigate gauging the risk of recession in the U.S. economy. I am Sandy Batten, Senior Economist at Haver Analytics. Last summer, after U.S. GDP had declined in each of the first two quarters of 2022, which is a widely held definition of a recession, I gave a presentation which looked at a rather extensive list of coincident and leading indicators of a U.S. recession. The conclusion drawn from that examination was that even though GDP had declined in the first half of 2022, the U.S. economy was not in a recession. As for the future, however, some, though not all, leading indicators were flashing yellow. Notwithstanding the recession concerns and the continuation of the Fed's aggressive increase in interest rates, the U.S. economy exhibited surprising resilience in the second half of 2022. The Fed's monetary policy tightening over the past year has been its most aggressive since it began targeting the Fed funds rate in the early 1980s. Yet, real GDP grew at an above-trend rate of 3.1% in the second half of 2022. Accordingly, the National Bureau of Economic Research's Business Cycle Dating Committee, the group that in the U.S. makes the official determination of the beginning and end of a recession, has not yet declared the U.S. to be in one. While the U.S. economy has avoided a recession thus far, the rebound in GDP in the second half of last year was due mostly to factors that are not expected to be sustained in 2023. Moreover, while supply was relatively strong in the second half of last year, demand was very weak. Real final sales to private domestic purchasers edged up by only 0.2% annualized in last year's fourth quarter. A narrowing of the trade deficit accounted for almost all of the GDP growth in Q3, while a rebound in inventories contributed more than half of the growth in Q4. More recently, however, the trade deficit has begun to widen again, and so it is not expected to contribute meaningfully to overall GDP growth going forward. And with demand having slowed markedly in Q4, much of the inventory rebound was likely unintended, and so could be reversed in the months ahead. So notwithstanding the rebound in the second half of last year, it seems that the U.S. economy is still facing a significant risk of recession. What is the message now from the coincident and leading indicators?
Has the economy entered a recession, or is it about to enter one? In this presentation, we revisit the group of recession indicators that we examined previously to once again investigate these questions.
Before we begin, note that the charts in this presentation, the light blue shaded areas are U.S. recessions as defined by the National Bureau of Economic Research. These are the four coincident indicators examined in the previous presentation: the econometric summarization of NBER variables, SALM's recession indicator, the Federal Reserve Bank of Chicago's National Activity Index, and the Federal Reserve Bank of Atlanta's GDP-based recession indicator. While the NBER Business Cycle Dating Committee is the official determiner of U.S. recessions, it doesn't perform this duty in a very timely fashion. So alternative gauges have been developed. The first one presented here is the econometric summarization of the variables the NBER uses in dating recessions, constructed by University of Oregon professor Jeremy Piger. These variables include real personal income less transfers, non-farm payroll employment, employment as measured by the household survey, real personal consumption expenditures, real wholesale and retail sales, and industrial production. Piger's measure encapsulates the information in these variables into a recession probability. Historically, 3 months of probability is above 80% have indicated the start of a recession. The most recent reading for December 2022 was 4.96%. While this is the highest reading since June 2009, it is far from the 80% level that historically has signaled the beginning of a recession. The second coincident indicator is one developed by Cloutier-Salm and employs changes in the unemployment rate to signal the onset of recession. According to Salm, when the difference between the 3-month moving average of the headline U.S. unemployment rate and the lowest 3-month average of the unemployment rate during the previous 12 months is 0.5 percentage point or more, the economy has entered a recession. The latest reading on the Salm indicator for January is minus 0.07%, well away from recession territory. The Federal Reserve Bank of Chicago's National Activity Index is another popular coincident indicator. It is a broad measure of economic activity that is expressed as standard deviations from trend. So a reading of 0 indicates that the economy is growing at its trend rate, and a reading of -1 means growth is one standard deviation below its trend.
A recession is indicated when the 3-month moving average of this index dips below minus 0.7.
This indicator has recently fallen below zero to minus 0.14 in November and minus 0.33 in December. So while the index is still not signaling that the economy is in a recession, it has moved toward recession territory over the past 2 months. A fourth coincident indicator is the Federal Reserve Bank of Atlanta's GDP-based recession indicator. It is not as timely as the previous three. It uses the dynamics of GDP growth to calculate the probability of a recession. The most recent reading is for Q3 2022. The indicator rose into worrisome territory in the first quarter of 2022 as real GDP contracted, but declined in both Q2 and Q3 to a less concerning level. The most recent reading of 8.3% for Q3 2022 is well below the 67% value that in the past has been associated with the onset of recession. So after revisiting the same four coincident recession indicators that we did 8 months ago, the conclusion remains the same. The US economy does not appear to currently be in a recession. There is, however, one important difference in the current environment from that of 8 months ago, and that is the state of the manufacturing sector. It could be argued that while the overall economy may not currently be in a recession, the manufacturing sector is. Indeed, manufacturing PMIs have fallen into contraction territory over the past several months, and manufacturing output has fallen 1.7% since October. Although the current weakness in manufacturing is not yet sufficiently severe to drag the entire economy into recession, it nonetheless raises a red flag about the risks facing the economy going forward. While the look at the coincident indicators may yield a somewhat sanguine view of the current state of the US economy, some historically reliable leading indicators are currently flashing yellow about what may lie ahead. Indeed, the risk of a near-term recession appears to be meaningful. Let's begin by looking at some key high-frequency leading indicators. Yield curves. The yield curve is a proven accurate predictor of recession. It is a graph of interest rates of increasing maturities at any point in time. However, since each yield curve is for just one point in time, it is very difficult to view a time series of yield curves. A widely used shorthand version of a yield curve is a graph of the difference between a longer-term rate and a shorter-term rate. Inversion occurs when the yield curve exceeds the long rate, that is, the difference between the two is negative. Yield curves have typically inverted ahead of recessions as financial markets think that shorter-term rates have risen so high that they will slow the economy and correspondingly fall in the future. The two most widely followed yield curves are the 10-year 3-month Treasury curve and the 10-year 2-year Treasury curve. These two yield curves have inverted ahead of every US recession over the past 50 years. Currently, both are inverted. In fact, the most inverted they have been since the early 1980s. This is clearly an ominous signal of a possible recession. Haver Analytics has used the information in the relationship between interest rates of various maturities to calculate the probability of a recession emerging in the US in the coming 12 months. These probabilities are calculated daily, and so they provide a real-time measure of the likelihood of recession over the coming year. Currently, both are overwhelmingly pointing to a recession occurring within the next 12 months. The first 12-month ahead recession probability is calculated from the 10-year 3-month Treasury yield spread. A marked rise in this probability can clearly be observed ahead of each recession over the past 50 years. Historically, this measure has recorded a value of 40% or higher ahead of a recession. While readings have declined slightly over the past few weeks, the most recent reading of 51% is sufficient to indicate a very high risk of a recession within the next 12 months. A second recession probability is calculated from the spread between the 3-month forward T-bill rate 18 months ahead, that is, the 3-month T-bill rate expected in 18 months, and the 3-month spot T-bill rate, that is, today's rate. Historically, readings of 80% or higher have been associated with a recession. This measure has also receded slightly over the past few weeks, but its most recent reading of just over 84% still points to a significant risk of a near-term recession. Deteriorating financial market conditions more generally can often signal the advent of a recession. However, apart from the yield curves and related constructs, other popular financial market indicators are not currently indicating a meaningful risk of recession. The Federal Reserve Bank of Chicago has developed a weekly index of US financial conditions that has risen ahead of recessions over the past 50 years. It is a comprehensive weekly aggregation of U.S. financial conditions in money markets, debt and equity markets, and the banking system. Readings below zero indicate that financial conditions are looser than normal. In an effort to rein in inflation, the Fed has been attempting to tighten financial conditions. Financial conditions were much looser than normal at the beginning of the Fed's rate hikes last March. The series of aggressive rate hikes began to tighten financial conditions during 2022, although the level remained looser than normal. However, it's better than expected inflation news late last year generated expectations in financial markets that the Fed had nearly completed this tightening cycle. Financial conditions have eased recently and currently are looser than normal and not pointing to any meaningful near-term recession risk. Similarly, for the credit spread is the difference between the yield on corporate debt and the yield on U.S. government debt, and is another variable financial market leading indicator. Ahead of a recession, financial markets usually become increasingly more concerned about the security of corporate debt relative to government debt. As a result, the yield on corporate debt typically rises relative to the yield on government debt, and accordingly, the difference between the two yields widens. Moreover, since the credit spread is calculated from market interest rates, it can be observed daily. The chart here is a representative daily credit spread, calculated as a difference between the yields on high-grade corporate debt and the 10-year Treasury note. In contrast to the recession angst generated by the yield curves, the credit spread is not currently exhibiting behavior that historically would be associated with meaningful recession risk. The Financial Stress Index, calculated by the U.S. Treasury's Office of Financial Research, is another financial market indicator currently not pointing to meaningful recession risk. This index combines information on 33 financial variables to construct a measure of stress currently being faced by financial markets. The index is positive when stress levels are above average and negative when stress levels are below average. While the index moved into well above average territory as the Fed raised interest rates last year, it has declined more recently and moved back into below average stress territory, and hence is not as concerning as it had been previously. Turning away from financial market indicators, the behavior of weekly unemployment claims has historically been a useful leading indicator of recession. Claims have typically risen as an economic expansion is nearing its end. Indeed, their rise during the spring and early summer of 2022 was interpreted by many analysts as signaling a pending downturn in the economy. However, since then, the number of weekly claims has mostly fallen and remains just above 50-year lows, hardly an indication of an imminent recession. The lack of recession signal from unemployment claims chimes with that of SOM's recession indicator discussed earlier in this presentation, which is based on the changes in the monthly employment rates and is also not signaling a recession. So what can we conclude from these high frequency indicators? The message is a little mixed. The Treasury yield curves and related constructs are signaling that a recession may be very near. However, other financial market indicators and unemployment claims are nowhere near territory that would indicate that recession is just around the corner. There are numerous, usually reliable, leading recession indicators that are released with a lower frequency than those already discussed, but nonetheless turn before the economy. So these leading indicators can be quite valuable in gauging when the economy might be headed for a recession. The most popular of these is the Conference Board's Index of Leading Indicators, composed of 10 variables that lead changes in economic activity. It is released monthly. This index has turned down ahead of every U.S. recession over the past 60 years. It is currently flashing vivid yellow. The index has declined for 10 consecutive months, and over the last 6 months, it has fallen 3.6%, a decline that in the past has always been associated with the recession. Another historically dependable, though less well-known leading indicator of recession is the Duncan Leading Index. Since it uses information from the national income and product accounts, it is available only on a quarterly basis. But this rather low frequency has not been a detriment, as the index has turned down at least a couple of quarters ahead of past recessions. The index focuses on components of the economy that historically have been very highly correlated with the business cycle, specifically real consumer spending on durable goods and real business fixed investment. Currently, the index is giving off a relatively clear recession signal. It is as it has declined in each of the past 3 quarters, at a pace consistent with past economic downturns. Three researchers at the Federal Reserve Bank of Chicago have constructed a leading recession index from an expanded set of variables that are included in the bank's National Activity Index. It is called the Brave Butters Kelly Leading Index, and it's available monthly. Like the National Activity Index, it is expressed in standard deviation units. Research conducted indicates that a reading below -1 standard deviation for several months has in the past signaled a recession occurring within the next 10 months. The index spent 11 months to June 2022 below -1 standard deviation, indicating a likely recession just ahead. However, since last June, the index has risen, not just above -1 standard deviation, but also back into positive territory in November and December. Those are the latest two available monthly readings. So the risk of the recession, according to this measure, has faded meaningfully over the past few months. Earlier in this presentation, we looked at the credit spread as a leading recession indicator. The Federal Reserve Board has employed corporate credit spreads to construct the probability of a recession emerging in the coming 12 months. This is reported on a monthly basis and is called excess bond premium implied recession risk in the next 12 months. Excess bond premium is the return on a bond over and above that required to compensate the bondholder for default risk. The rise in excess bond premium indicates that financial markets are becoming more concerned about the safety of corporate debt relative to government debt, and so are demanding a larger rate differential to hold corporate debt. A rise in spread has historically been associated with an increased probability of the economy sliding into recession. This probability has generally risen over the past few months, but the levels well below lows associated with previous recessions, and hence is not exhibiting much indication of increased recession risk. Consumer expectations have also been a useful leading indicator of recession. There are two widely followed indexes of consumer expectations, one from the University of Michigan and a second from the Conference Board. The University of Michigan's index is published twice each month, while the Conference Board's index is published only monthly. Note that the useful information for gauging recession risk is contained in the expectations components of these indexes, not the headline consumer sentiment indexes themselves. Consumer expectations have usually deteriorated prior to the onset of recession. Currently, these indexes are indicating elevated recession risk. However, after having fallen precipitously from the middle of 2021 to the middle of 2022, both have rebounded in recent months, even though they remained at depressed levels that are consistent with some, though not all, previous recessions. The nature of payroll employment revisions is related to the business cycle. In particular, revisions to employment are positively correlated with economic activity, positive as the economy expands, and negative as the economy slows and heads into recession. Haver Analytics maintains a series of the first announced values of the monthly payroll employment figures, which thereby enables analysis of the revisions contained in subsequent releases. The most recent revisions to employment have slowed markedly, but are still positive. Consequently, while smaller revisions may indicate that the economy has slowed, they do not yet appear to be pointing to near-term recession risk. So, what can we conclude from our look at this wide-ranging group of recession indicators? It seems fairly clear that the U.S. economy is not currently in a recession. This consistent message from all the coincident recession indicators included in this presentation. But with the Fed having tightened monetary policy aggressively and the economy slowing in the year end, could a recession be near? A slowing economy is more vulnerable to shocks and the emergence of imbalances that could lead to a recession. However, the reading on this from the leading recession indicators in this presentation is somewhat mixed. Several of the leading recession indicators, notably the yield curves and related constructs, the index of leading indicators, and the Duncan leading index, are clearly flashing yellow, indicating that a recession is likely in the near term. By contrast, credit spreads, domestic financial conditions, global financial stress, unemployment claims, unemployment revisions, and the BBK leading index are not currently pointing to any near-term risk. To be sure, these are unusual times. The economy has become more fragile. Inflation, though slowing, remains unacceptably elevated, while the labor market is as tight as it has been in more than 50 years. The Fed has responded to the rise in inflation with the most aggressive tightening of monetary policy in more than 40 years. Historically, it has been very difficult for the Fed to engineer a soft landing when it pushes up interest rates. As a result, with monetary policy already very tight and with further tightening expecting ahead, the risk of a U.S. recession looms large. So the indicators contained in this presentation should be followed carefully for signs of any deterioration in the U.S. economy or its outlook. Thank you for joining me today. If you have any questions on the content of this presentation, please don't hesitate to contact me or your HARA representative.